Hi everyone, welcome to this live event. As usual, I will share with you my view of the market for this week and a review of the calendar and the technical levels we can take care of these days. So as usual, let's start with the calendar. Let me share it with you. Uh, okay, there we are. Okay, before starting reviewing the calendar, it's clear that this second half of 2016 has been mostly a political driven market, right? Political events have taken center stage, and we are seeing the market reacting to U.S. elections, Donald Trump victory, right? And this weekend, the key was the Italian referendum, right? Which ended up with Prime Minister Matteo Renzi um, resigning, okay, because he proposed a constitutional reform to reduce the key factor of the of the referendums was to reduce the number of members in the Senate to speed up laws to try to boost the depressed economy and the bad situation in Italy is going on. But he lost, right? So that's why he resigned. As it happened with the US elections, the market was really anticipating a lot of turmoil, a lot of risk of after the event. And in fact, as it happened with the US elections, we had a small reaction, a short-lived market reaction during the Asian session, but the market changed course afterwards, and sentiment turned sharply positive, right, against all odds. That's what's going on in the market. I don't know. I do believe that the market has been pricing in way too much whatever the risk of the upcoming events will have. That includes Brexit also. We have been pricing in a hard Brexit for at least 2 or 3 months. And last week, things changed when both the UK and the EU authorities uh, said that they will try to find a way to keep the UK within the single market, which of course will be a huge relief for the UK economy if they anyway leave the euro area. Anyway, let's move to the calendar. This is the last month of the year. We are having two big banks events, the ECB this Thursday, the Fed next week, next Wednesday, right? And both are expected to bring news and bring changes in the economic policies. The ECB is expected to extend the date of its uh, easing program, okay? Not to enlarge the amount of stimulus, not to change the 80 billion euro purchases a month, just to extend it beyond March 2017, which was the initial end date, right? Draghi says March 2017 or as long as it takes. Well, we're expecting him to change that wording into September, at least 6 months, September 2017. But indeed, the stimulus program is doing little for inflation in the euro area. And I do believe that that's not there to do much more than what he's actually doing. So that's not good news for the common currency in spite of the 300 pips recovery we have witnessed yesterday. On the other hand, the Fed is expected to raise rates next week, but I do believe that policymakers have ensured that the market won't react badly to the movement, right? Because they have been anticipating such move for almost 2 months already. In fact, I do believe that the market reaction will be most likely to be shocking if Fed leaves rates on hold, right? Because the rate hike has been already priced in, and it should not affect much stocks. We are not going to see those huge inverse correlation we have been seeing with rates and stocks ever since the 2007-2008 crisis. Anyway, We had the services and composite finals PMIs in Europe, despite there was a slightly revision towards the downside in the final estimates compared to the initial ones. The fact is that the euro area PMI stands at an 11-month high. So the fact is that the economy keeps growing, and despite you see a red here, that's not bad news. What I'm seeing as bad news, as for what we had yesterday, is that investors' confidence is decreasing. Right, this is the measure for December, and it's down to 10. I guess all the political turmoil and elections and Brexit and Italy and Draghi has weighed on this figure. Okay, the market services PME in the US was below previous, slightly below previous, but the one made by the government was hugely positive. So I believe that this is still signaling that the U.S. economy is growing steady. So no much to take out of that. Yesterday, or sorry, earlier today in the Asian session, the Reserve Bank of Australia had its economic policy meeting, okay, and they left rates unchanged at 1.5% as largely expected. The outlook was mixed. The market is expecting, GDP to shrunk during the last quarter of the year. Inflation has made no much progress, and Governor Lowe shows some concerns over the employment sector. As despite we have seen some good numbers lately, the fact is that partial time employment is the one that's actually growing, right? Part-time jobs. So uh, that's why the OC is under pressure probably today. I don't see much in the calendar that can affect the market today. Maybe factory orders in the US, but nothing that really could change what's going on in the market. On Wednesday, manufacturing and industrial production in the UK can give some clues about the health of the economy there. Still, we are expecting good numbers and we're expecting the pound to keep on rising. I could say that the news or GDP estimate will be more relevant as usual, right? It's an estimation of the 3 months to November, right? It's the user GDP estimate is released monthly and it's measuring the growth of the last 3 months. So this is the 3 months to November. We have the Bank of Canada, right? But the Bank of Canada is largely expected to remain on hold also. On Thursday, of course, market attention will center on the ECB, but take care of the Chinese figures to be released during the Asian session, because imports and exports have showed signs of improve in the past month, but not enough to reverse the negative tone we have seen earlier this year, and a fall in exports and imports could revive fears of economic slowdown and therefore weight on the market, weight mostly on the OC, but in general, it generate risk aversion on fears that such economic slowdown could spread into the rest of the world. On the ECB, I do believe that I already commented, we are not expecting any changes in rates, not a change in the amount of bond purchases, just an extension of quantitative easing uh, for at least 6 months. Okay. Friday, inflation in China, it's the same as we comment with trade balance with export and import figures. The market will be paying much of attention to these numbers, as rising inflation will be a sign of health in the economy. Sorry, and of course, worse than expected numbers will probably generate again risk aversion. Okay. Anyway, not much else. But the Michigan sentiment in the US, it's a preliminary December figure. Uh, so it's usually a market mover, but not that big. Okay. Anyway, let me change to the charts. Sorry. Uh, Okay, here we are. Let me start with the euro. Okay. Okay, well, the pair bottom at a fresh year low yesterday, 504. We had past December low at 505 and November at 517, if I'm not wrong. So actually, this is a strong static support level. What no one was seeing is this sharp recovery that came afterwards in the back of renewed hopes that the financial banking system in Italy was one expanding to the rest of Europe. Anyway, from a technical point of view, I drew a Fibonacci retracement between the post US election high and that low, and I found out that the 38.2% retracement of that decline came around 800. I have my 200 simple moving average in the same level in these 4-hour charts. There was a slightly positive tone, right, coming from the 20 simple moving average crossing above the 101 and indicators holding within positive territory. But overall, there's not much of an upward potential in the pair in the longer view, at least until we recover above 840, 850. You know, we have talked about these levels plenty of times. It has been holding above that level. It has been a huge support in between early 2015 and for most of this year. So actually, this is for me like the line in the sand, the level to retake, okay, to talk about further recoveries in the euro dollar. So the first resistance is that 800, 810, followed by 840, 860. If a pair manages to regain this loss, there's a good chance that it will extend in its recovery towards the 110 region later in the week. Okay. On the other hand, if the short term, the immediate support for me is today low around 730. I do believe that if we lost that level, then 690 comes next, and if we lost 690, the pair can go back to the comfort zone we had in between 630, 650, right? But if we fell below that last, I still see scope for fresh lows beneath that 505 and down to 460, which was 2015 yearly low. Okay, and the pound has been advancing ever since um, authorities talk about the possibility of a softer Brexit, right? So here we are holding at fresh highs. Daily basis, the pair has been doing higher highs and higher lows. So overall, the bullish tone is still present. I was looking at this low around 27.93, okay, as the immediate resistance now. I believe that if we can get above that level, we can go up to August low, which was 28.65, right? And if somehow the pair can regain that level, particularly if the dollar is weak on bad data or on a poor Fed outcome, we can go back to 130. But honestly, I still can see that the pair breaking through 130 in the upcoming days or in the upcoming weeks, to be honest. I don't see it breaking above 130 this year. Anyway, those are the resistance. And when it comes to the supports, I believe that in here, when we have previous highs, 2690, 2710, that's the strong static support region. So if the pair falls back below that level, then we can see it correcting further lower down to this price zone. 2620 is my first bearish target, and below that level, I do see the pair accelerating the slide down to 25. What's actually interesting these days is the dollar Japanese yen. Uh, this is a huge Fibonacci retracement, the 23.6% retracement of the 2011-2015 rally, right? And It's around 14, and the pair reached it and held above it and below it and back below and back above. The fact is that we're in a consolidated stage around that level. So I do see that the downward risk is limited. However, I'm not still seeing a clear break of this region. The pair has set sort of a double roof, a double top around 1480, right, and able to move beyond it. But dips are still seen as buying opportunities when market uh, once the pair fall, it starts recovering fast. So overall, I'm still favoring the upside. Sorry, so but I do believe that the pair needs to break above 15, right, to be able to extend its gains. If the Fed rise rates, and despite the market has been pricing in much of the movement, and there's a good chance that the pair can surpass 16 and reach 1660, which for me is a strong static resistance level. But I'm not seeing much action going on in this particular one ahead of the Fed, not the ECB, but the Fed. We can see more seesawing around this 14 region, but honestly, I'm not expecting a real breakout until the Fed outcome. Sorry, not having my best day today. Anyway, short term, 1330 is the immediate support, 1280 comes next. Below this one, we can go back down to 112, but I'm not seeing much of a bearish potential unless the pair breaks below 1130. Take a look at this daily chart. We have plenty of heights and lows around that level. So down to this level, I still believe that the pair will be a buy on dips, okay? And I was watching the Aussie also. Give me a second. Okay, here we are. Uh, Another one that has found selling interest and search sort of a double top. This is not as valid because uh, a double top is valid at the end of a bullish trend, and this one is in the middle of a bearish trend, so not actually by a double top. But what we can see here is that the pair was rejected by the 75 level twice. Okay, lately, last week, this week, so no, not much of a bullish bias in here, okay? Despite whatever technical readings are saying the price is unable to settle firmly above this 2450 region, and it's also hovering around it. There's a limited follow through in the shorter term. In fact, indicators are correcting, but what I'm seeing here mostly is a consolidated stage, not much of a definitions to be honest in this area. I would like to see the pair breaking either below 73 or really accelerating above that 75 to see a clearer picture and a clearer trend. In the meantime, I'm not really happy with the Austin's behavior. I'm not willing to trade this particular one. Okay, and when it comes to gold, I was watching the weeklies and the daily charts because the slump has been brutal over the past 4 weeks, right? But the bearish momentum seems to be decelerating in the shorter term, which should not be a surprise because production cost for gold is 1100, 1150. So actually, the price has fell towards or near the production cost this week. So it's pretty logical that the downward potential is limited, right? But I still believe that we can go further lower, and there's a good chance that the pair will go back to the lows set last December around 1046. Okay, so that's what I'm watching in gold prices these days. Shorter term, right? There's a slightly bearish tone present, but not enough to suggest that we're going to see a break lower. I do believe that the market will turn conservative with gold until the Fed also. We may see some spikes either side of the board with the ECB, but the market will save its bullets for next week, right? Anyway, uh, we have a short-term support around 1166, followed by this week low around 1157. I do believe that a break below this level should see downward acceleration. 1140 seems for me the next probable target. 1140, 1142. Okay, towards the upside. 1176 is my first resistance solo. Sorry, follow for this followed fight by this high 1187, and above it 1190.92 comes next. I'm not seeing it recovering beyond 2000 anytime soon. Uh, of course, if the Fed keeps on hold, we will probably see it breaking through 2000. Okay, and finally, oil prices. The OPEC reached a deal. Yeah, against all odds. That's those are the words of the all, against all odds to reduce oil production, and here we are. U.S. oil topped at 52, the higher end of its latest range. If you take a look at the bigger time frames, you will understand what I mean. 52 is huge resistance area. We have lows, highs, weekly, monthly, daily. So it has reached that level, and so far didn't retrace, but beware that it won't be easy breaking higher. Over this weekend, uh, the OPEC will have a meeting with 14 non-OPEC countries and will invite them to join their production cut and even and try to reduce further worldwide oil output. So if they come to an agreement, then there's a good chance that the commodity will break higher. Okay. On the other hand, if they fail, the commodity will begin to retrace. But I do believe that market enthusiasm at this point is strong enough, and we're not going to see any kind of slide below 49 in the days to come. Okay, that's for me sort of line in the sand. 50, 60 is my immediate support. 49.90 comes next, and then 49. Okay, guys, sorry, but that's it for today. Uh, I'm sorry I'm not in my best day, but hope I was useful to someone anyway. Thank you, and see you next Thursday when we will cover live the ECB. Okay, thank you, and bye bye.